just write out put call parity. And then we still need to place the remaining two security in this equation. So ask yourself, if you have a call, what do you need when you exercise this call? You need money. So therefore, you should have a bond that gives you that value today, at maturity. Right? So that's why you put the present value of the bond, which is this is the risk-free bond. Right? Already remember in here we're always talking about risk-free bond. Okay? Now on the other side, if you have a put option, what do you need if you want to exercise the put option? You need the underlying asset. Right? Because if you exercise the put option, you have the right to sell. So you need the stock to sell. Alright? So this is how I remember the put call parity. You never make a mistake. If you understand, of course, you need to understand when you exercise a call, what do you need? When you exercise a put, what do you need? Alright? We will use this equation to find the price of put and also in capital structure analysis. Alright? Now let's look at this simple example how we make arbitrage profit if the put call parity does not hold. Alright? So let's assume stock price 110 and the put premium is $5 and the call premium is 17, and assume the risk-free rate, annual rate is 10.25, and the maturity of the put and the call is half of the year. Alright? And let's assume the strike price is 105 of the call option and the put option. So if you put everything into the put call parity, one side is the put option and the stock. The total cost is 115. The other side is the call option and the price of the bond. Now the price of a bond is the present value of its face value. The face value is 105, and this bond only has 6 months maturity. So therefore, we have to discount the face value back for 6 months. So the annual interest rate is 10.25%. So that means 6 months is just 5%. All right. So if you do it, you should get 117. So now they are not equal. So we will have an arbitrage opportunity. So what you do is buy low and sell high. Right? That is, you buy the put option, you buy the stock, and then you sell the call option, and then you sell the bond. That is, you borrow money. Alright? So now if you look at your immediate cash flow and the cash flow at maturity, that's 6 months later. No matter what happened, your cash flow will be zero. If the stock price is less than the 105, or if the stock price is higher than 105. In both cases, your net cash flow is zero. But today, you have a net inflow of $2. So this is an arbitrage profit. Alright? But you are not happy with just $2 profit. What you will do is you scale up. Then you buy 10 of this and you sell 10 of this. You buy 100 of this, you sell 100 of it at the same time. So if you keep buying the lowest cost portfolio, the price will be up. If you keep selling the higher cost portfolio, the price will be down. So at equilibrium, the two should be the same. Alright? So this assumption is we do not have any transaction cost. If there's transaction cost, then the difference may be equal to the transaction cost. This is possible. Okay? Now, let's come back to look at the price of option. Now, there are several relations between call option and put option and the other variable. All right? Now, some of them very obvious. Or if you, okay, one thing is, you don't believe it, you can just look at this option paid profit and losses diagram to illustrate the point. You can use it. All right? Okay, all right. So let's just come back to here first. Okay. Now, the first two very obvious. So we know for call and put, right? We know the intrinsic value of a call is equal to, the intrinsic value of the call is the maximum of the price, the spot price at any time t, all right, minus the strike price or 0. So that's the intrinsic value of a call, right? And the intrinsic value of a put is the maximum of the strike price, the strike price minus the spot price and 0. All right? So if you look at the first two, the higher the stock price, definitely the higher the intrinsic value of a call. So we know call premium is, option premium is always equal to intrinsic value plus the speculative value. All right? So assuming all other remain the same, we can obviously see that higher strike price, higher call premium. Now for put, this is this one. That means the highest the stock price, the lower the intrinsic value of a put option. So therefore, they have inverse relation. All right? Now the second variable this time is about the strike price. So now you can see the higher the strike price, the smaller the intrinsic value of a call option. All right? And the higher the strike price, the higher the intrinsic value of a put option. So therefore, this time is a negative and positive relation. Okay? Trust me, understanding this in this relation is more important than knowing the formula. Alright? Because in reality, sometimes you don't have the time to do the calculation. Suddenly you have information, you have to make the decision by itself. Then based on all this, what we call sensitivity analysis. Okay? Now, next is about interest rate. Alright? Interest rate. Now, even if you do not know anything, but you can just show here. Let's say you look at a call option, 50 call option, just enter 1. Alright, so you can see the price here is $3.32. Now you can change the interest rate and make it 10% and see what the price will be. So now you can see the price here will be $4.27. So you can see, higher the interest rate, higher the call premium. Alright? So put option, you can do the same thing. So I would leave it to you at home. You can see, make sure you know, okay, I don't believe what you discussed in class, and you just check the formula. Yeah, you can do it. Alright? The same thing, you can change year to 1 year, 2 year maturity. You can change the volatility, 21%, 30%, 40%, and see what happened to the call premium and the put premium. Alright? But let me just explain why this is the case. Now, if you have high interest rate, remember, for call, you only put down a deposit. You don't need to pay for the $900 for the TV. Right? That's the example we used last week. So if high interest rate, let's say interest rate is 100%. So if you save $900 today by buying a call, now 30 days later, let's say interest rate 30 days 100%, 900 becomes 1,800. So that means this deposit has a very, very high value. Because you buy the TV today, you have to pay $1,000, then you cannot earn the interest in the next 30 days. But now you only put $100 deposit, and you keep $900 and earn 100% interest rate. All right? Then you have 1,800. So this option is extremely, extremely valuable to you. All right? I always try to understand relation using extreme example. Okay, simple, extreme example. Trust me, it will make your idea everything very clear using extreme, simple example. All right? Now, for put option, it's the opposite. Put option is, I have to hold this security. I buy the TV, all right? And I can return it in 30 days. So same thing, if interest rate is 100%, if I return it today, I will get $1,000, and at the end of the period, I have 2,000, right? But if I do not return it, and I just return it at the end, I only get 1,000. So therefore, if interest rate is very, very high, then the put option will have a lower value. So that's why it has a negative relation. Makes sense, right? Okay. Now the other two, they both are the same, not one negative, one positive. Now, one is the volatility in the underlying stock. That is whether the standard deviation of stock is high or low. Again, look at an extreme example. All right. So let's assume the stock price 10, and you have one at the money call option. So that means the strike price is also 10. Now, so that's two security, right? Two options. One, both they have the same at the money $10 strike price, and the stock price is 10. Look at the extreme example. One, the underlying asset has zero volatility. That means it will not change. The price is 10 forever. The other one, there's 100% volatility. Now think about it. Which option you will buy? Definitely this one, because this one you never make any money. Alright? The strike price is 10, the stock price is 10, the price will stay at 10 forever. So there's no way you are willing to pay any speculative value. The intrinsic value of this option is 0, call option 0, but the speculative value is also 0 because the standard deviation is 0, you never move. But this one, even though the intrinsic value is 0, but the speculative value will be high because it can move up and down all the time. Alright? Same thing for put option. Just assume the same exercise. This is the put option at the money. This is also put option at the money, but this stock price never moves. That means the volatility is 0, standard deviation 0. And this one extremely volatile. Of course, you will buy this one, not this one, because this one will never have any positive value. Alright? And the last one, expiration date. Again, look at extreme example. Two options, alright? One is they will, let's assume, again, at the money. This option will expire in the next second, and this option will expire in 10 years. Alright, if they have the same price, which one you will buy? For sure this one, because 1 second is almost impossible to price to move anything, right? That's gone, 1 second. So this one, the speculative value of this option will be very, very small or exactly 0. But this one, you have 10 years, 5 years, then you have a higher chance you make money. So therefore, you're willing to pay more for this longer maturity option. No matter it's a put option or call option. Alright? Now the exact price relation is, that is the call today, so this 0 in today, is always in between the two, which is, this is the intrinsic value. Right? This is the intrinsic value. And the one is the stock price. Right? It makes sense because this, we assume the stock will not pay dividends. There's no way you pay more to buy the TV. Right? The TV is $1,000. Why you pay $1,100 deposit to buy the TV and pay something in the future to get it? No way. Doesn't make sense. Alright? So the deposit cannot be more than the price of the TV today. So that's why we have the call premium must be less than the price of the underlying asset today. Right? Especially we are talking about stock. There's almost no carrying cost. Only carrying cost is interest. Alright? So this is what you expect to have. So this is the stock price, right? At maturity, and this is the intrinsic value. Okay? And that means at maturity, your value will be this. So the green line is your payoff. Now, before maturity, your value will look like the red curve here, or line, whatever we call it. Alright? So anything on this side is in money, anything on this side is out of the money. And here is at the money. So according to what we have, we can see that, well, at the money option, they should have the highest speculative value. Now, if it's deeply in the money, the speculative value is almost 0. Right? Anything moves the stock price is equal to what will happen to the call option. All right? Or if deep out of the money, then even you increase the stock price by $1, $2, the call option will have no change in value because it's almost impossible to become in the money because it is deeply out of the money. All right? Okay, now let's look at the binomial option pricing model. Now this is actually a very simple exercise. Let's assume the stock price of the underlying asset is $100 today, and the price will either go up to 200 or goes down to 50 with probability of P and 1 minus P respectively. All right? So we label it as SU. That means if the price is up, the stock price is 200. D stands for if the price is down, it is 50. All right? Now, at the same time, we have a call option, and the call option value depends on the underlying asset price. So that's why we call it derivative. All right? Because its value is derived from the underlying asset. So let's assume the strike price is 125, and the risk-free rate for that, for one period, for this particular period, is 8%. Now this period can be a year, can be a month, can be a day, can be a second, can be any time period. All right? So as long as you know, well, the risk-free rate for that period. So what you need is to calculate what the interest rate or risk-free rate for that particular period. All right? So the first thing, you are given the stock price, you are given the price when it's up, the price when it's down. All right? And you are given the strike price of this call option, and you are also given the risk-free rate for that particular period. All right? Now the first step is to determine what is the call payoff if the price is up. What is the call payoff if the stock price or the underlying asset is down? All right? So the first thing, very obvious. If the price is 200, then with a strike price of 125, and this is the end of the maturity, so that means it's only the intrinsic value. So we know the intrinsic value is the maximum of the stock price minus the strike price. So in this case, 200 minus 125 gives you 75. Right? Now, if the stock price goes down, this time, same equation, the maximum of the stock price minus the strike price over 0. Alright? So this time, 50 minus 125 give you negative 75. So the maximum of negative 75 and 0, of course, is 0. So therefore, it is 0. Alright? So after you figure out the payoff to the call option under the two different possible outcomes, you are worth 1/3 done of this question. Alright? Now, let's look at the first approach. We call it a replicating portfolio approach. Now, a replicating portfolio approach is, can we repeat the cash flow of this call option or replicate the cash flow of this call option? Can we do something so that our future payoff will be either 75 if the stock price goes up, or 0 if the stock price goes down? If yes, then this synthetic option should have the same value of the will option, will call option, right? Because these two, that is the will option and this synthetic call option, if they have exactly the same future cash flow, then they also should have the same price today. All right? So that means the cost of this synthetic call should have the same price as the call option. So can we do that? Well, let's try. So any security we know in this market, well, basically you should know the stock price, right? You are given the stock price right now is 100 today. Right? And we know the stock price will be either 200 or 50 at the end of the period. Right? So that's the one security we know the pricing information. And second security, we know the pricing information is the government bond, since we know the risk-free rate. All right? So if we look at the government bond, which has a face value of 125 or whatever, I mean, doesn't really matter, 125, anything, right? That means we know the price today because we discount the face value using the 8% risk-free rate, and that's the price of the bond today. So those are the information available. So why not we try combining these two securities and create a synthetic call option, right? So what we want to do is, okay, we want to buy delta. So delta is just a variable. Don't worry about they use a delta because delta is hash ratio, right? In stat or in calculus. You can call it A, you can call it B, you can call it C or X and Y, just a variable, right? No special name, just like beta. Why do you call it beta? Right? Because beta is just regression, the coefficient of regression, so that's why they call it beta. Right? The alpha, why they call it alpha? Because that's the intercept of a regression line, so that's why they call it alpha. Right? The same thing here. So they just call it beta, delta, because it is the change of, actually it is the change. This is the slope of this line. Right? This is the slope of this line, or you can call it delta change of S over change of C over change of S. Alright, so that's why I call it delta. Alright? So let's say you purchase this number of the underlying asset. Right? It's the stock. Buy 2 share, 1 share, 0.5 share, 0.4 share, any number. And at the same time, you borrow this amount of money. Right? You borrow this amount of money at the risk-free rate. That is, you short sell government bond. You borrow the government bond from your friend and sell it in the market. Right? At maturity, right? At maturity, you have to return the government bond, the face value, to your friend. Right? So that's short selling. All right? So the cost of this is you have to pay this amount, you receive this amount because you borrow money. So this is a leverage position. You borrow money to buy stock, or you purchase stock on credit, margin purchase. Okay. Now what you need is you want the amount you borrow and the number of shares you buy give you exactly the same cash flow. So if the price increase, that means if the price 200, this is your stock holding, right? It's because you own delta number of shares. So this is the value of your stock holding. But you have to pay back the debt because you borrowed B today and you have to pay 8% interest on the amount you borrowed today. So this is how much you have to pay at maturity. So that's B times 1 plus the risk-free rate, right? So we want this to give you 75, right? Because this is the stock price when the stock price is up. Now, when the stock price is down, your stock holding will be $50 times the number of shares you own, right? But no matter what, you have to pay the same amount because you borrow this money, you have to pay off the debt and interest. And you want this cash flow just equal to 0. So if you look at here, we have 2 equations, 2 unknown. So I believe everyone should know how to solve a 2 equation, 2 unknown system, right? So this one is easy, just subtract one from the other because this one is identical, right? This one is just identical. So if you subtract the second one and the first one, you always get delta SU minus delta SD equal to CU minus CD. So that's why we have this expression. All right. So you can see that delta actually is a swing of the call and a swing of the stock. So in the binomial model, it's the range. You can call it the range of the call premium and the range of the stock price, right? Because the call and put, the highest possible value is 75, the lowest value is 0. For the stock, the highest value is 200, and it will be over 50 when the price down. All right. So you get this delta is 1/2. So we call this is a hatch ratio. This hatch ratio is extremely useful when you trade options. All right. Okay. Now, once you have delta, then what you need is you pick either one of it. So this equation using the second equation. So here, you're using this equation to solve for B, because you know what delta is. You know, we know this is 50, right? Because we know it's 50, we know this is 0.8, 0.08, right? So if you know this is 1/2, and you can find what B is. Right? So this formula using the second equation, well, you can use the first equation, you get exactly the same B anyway. Alright? Okay? So now if you do the math, and you will find, okay, if we buy half of the stock today, that would cost you $50. And then borrow 23.15 today. So that means you would get this amount today. So the cost of the synthetic call option is 26.85. So that means the true real call option will also have a price of 26.85.
So you have 100 million inputs.
Right? So any question about this synthetic call option, or what we call the replicating portfolio approach? Yeah. CU is the payoff to the call option when the stock price is up. CD is the payoff of the call option when the stock price is down. Right? So SU is the price of the stock when the price is up, and the price of the stock when the price is down. So C is just the call, the premium, or the payoff of the payoff actually, the payoff of the call. If the price is up, the payoff of the call, the stock price is down.
And that's how you can actually do it.
So in this case, you can see CU is 75. You just calculate right here. Right? And this is CD 0. Alright? Now let me just try 2 more exercises. Alright? And let's try, one is, hey, what happens if the strike price is 250? Everything is the same. Everything is the same. But the strike price is 250. Alright? And let's calculate the replicating portfolio approach and determine what it is. So the first thing is to define what is your CU and what is your CD. Right? Now, if the strike price is 250, okay, so let's look back to this here. If instead of 125, if the strike price is 250, CU, we know it should be 0. Because 200 minus 250, right, is negative. So therefore it's 0. Now, if the stock price is 50, CP will also be 0. Because 50 minus 250, negative, 0. Alright? So in this case, if you calculate your delta, you also get 0. If you calculate B, it's also 0. Right? And then, of course, the call is also 0 today. Right? It's your delta, and the B is 0. Right? Now let me show this using the diagram how it look like. Okay? So right now the price is 100 today. Okay? It will be either okay, let's side. Let's say 100 right here. This is 50, and this is 200, and this is 250. Right? Okay. Now, this is the call. Right now, if you look at the intrinsic value, if we have 125 is your strike price, now the payoff will be look like this. Right? And the actual price will be something like this. So at this point, the slope of this line, 1/2. So that's why when we calculate the delta, when the strike price is 125, we get delta equal to 1/2. That's the slope of the red line at that point. Okay? All right. Now I will have to erase this one here because I want to show another diagram this time is when the strike price is 250. When the strike price is 250. So this line this time will look like this. Right? And now the actual price will be somewhere like this. Okay? So now, oh, sorry. Okay, sorry. Let's go back. I made a mistake here. Okay. I'm sorry. Because the strike price is 125, all right? Okay. All right, let's do it. Let's do it one more time. Okay, you draw this line, and this is what happened right here. Because the stock price right here is 120, not 100, not 125. Okay, so therefore, this is the slope at this point, 1/2. The slope of this point, the tangent line, has a slope of 1/2 at 100, not 125.
Wow.
That's a mistake. It's 100, not 125. All right, 125 is only a strike price.
Exactly.
Okay. All right. Now. Okay, right? Okay. Now let's try the second one. This time is when strike price is 250. So when the strike price this time is 250, so that means this should be this one here or here. Now if you draw the actual price before maturity, that is when the price is 100 here, the slope of this point is 0 because it's almost flat. Right? I do not draw it very nice, but it should almost flat. Alright? Because this option, if the strike price is 250, this option is deeply out of the money. It would never be in the money because the two possible price is only 50 and 200. But the strike price is 250. So therefore, this option would never be in the money. Alright? So no matter what change to the stock price, it would not almost impossible to move the call premium up by a little bit. Right? Because you have to increase $150, but in this case it's not possible. Right? Because the highest price is only 200. So that's why the delta in this example is 0. Okay? So the delta actually is the slope of the red line at the current market price, 100. Alright? Okay. Now let's try another example this time. Is when the strike price, let's say use a different color. When the strike price is only $25 instead of $250, and this time the strike price only $25. Right? Now, if the strike price is 25, CU in this case will be 175 because 200 minus 25 instead of 125 is just 25, right? Take away this one. So 200 minus 25 give you 175. And CD this time is also positive because 50 minus 25 gives you 25. So if the strike price is 25, this call option will always in the money. Always in the money. Alright? So let's calculate the delta in this case. So if you do the calculation, delta is equal to 175 minus 25 over 200 minus 50, which is equal to 1. That means for every $1 increase in the stock price, your call premium will also increase by $1. So that's the slope of the red line. Right? So if you calculate a B, if you calculate a B, let me just do it. It's 23.15, and the call will have a price of 76.85. this call will have a price of 78.85. Now if I draw the diagram, so this time the strike price is 25. So the diagram will look like this. Right? And then the red line will be something look like this. So therefore, at this point, the slope is 1. Right? Because it's almost the same as the 45-degree line. So that's why the slope is 1 in this case. Okay? So delta actually is the slope of the option pricing curve at that price. So 100 right now. Okay? So any question about the replicating portfolio for call option? No? Now let's look at put option. So assume the same underlying stock, and this time we have a put option with a strike price of 125. Right? So this time is not a call option. So what you need again is to determine the payoff to the put option when the price is up, and the payoff to the put option when the price is down. Alright? So this time the payoff is the maximum of the strike price minus the stock price over 0. So if you do the calculation, this one will be maximum of 125 minus 200 over 0. So 125 minus 200 is negative, so therefore it is 0. Right? And when the stock price is down, which is 50, this time the maximum of 125 minus 50 over 0 gives me 75. So the first step is always determine the payoff to the option, either call or put, at expiration, when the price is up, when the price is down. Alright? Now, you can use exactly the same approach. This time, we want to create or construct a synthetic put. So this synthetic put will have the same payoff as a real put at maturity. Alright? Again, we use stock and we use the government risk-free bond, borrowing or lending. Alright? So this time we borrow this amount of money and we purchase this number of underlying option stock, right? And we want the payoff to be exactly equal to the payoff of a put option. So you can see this is exactly the same formula. It's same as a call. Alright, so even you look at it, the delta is exactly the same formula. Instead of CU and CD, you just replace it by PU and PD. Alright, now this time you can see this is negative 1/2. Okay, from this diagram you know why it is positive. Because call options go like this. Put options, remember, go that way. Right? I mean, put options have a negative slope. Right? I will draw the diagram later on, but it can tell you the same idea. This is the slope of the red line for a put option. Go that way, not this way. Alright? And then you determine how much you borrow. So in this case, you borrow a negative amount. That means you lend money instead of borrowing money. Alright? Okay? So B is the amount you borrow. Remember, B is the amount you borrow. In this case, you borrow a negative amount. Actually, you buy government bond. Right? It's the same as you lend money to the government. So when you buy the government bond, you lend money to the government. Right? So in this case, you sell 1/2 of the stock. Right? You short sell 1/2 of the stock, and then you borrow money. You lend money. Right? You borrow because you borrow a negative amount. Right? And the net cost is 42.59. Alright, so if we draw the diagram here, let me do the same thing here. So now this is also 50, 100, and this is 125, this is 200. Alright, okay. So if your strike price here is 125, so it should be look like this. Right? Right, so this should be your diagram. And this intercept should be 125, we know, right? Okay, right? So the lines right here should be something look like this. Okay, and the slope at this point, the delta at this point at price of 100, this is negative 100. Alright. Now let's try the same exercise. Let's assume this time the strike price is, let's say, 250. Alright, exactly the same thing, but this time is a put option. So the first step is to determine what your PU is and what your PD is. So if the strike price is 250, and we know the payoff to the put option is the maximum of the strike price minus the spot price or the stock price. Alright, so that means it's 250 minus 200, that gives you 50. Alright, and next will be the 250 minus 50, that gives you 200. Okay, and now what you need is to determine your delta. So if you do the calculation, the delta is PU minus PD, which is 50 minus 200 over SU minus SD. So SU in this case is 200 and SD is 50. Yeah, 250. So that's why this is negative 1. Right? If the strike price is 250, this put option now is deep in the money. Right? Okay? And if you calculate your B, so you put in the formula, your calculator B is negative 231.48. And now you calculate your put option, this time you have a price of 131.48. Because now this diagram will look like this, right? So now if the strike price is 250 here, so it should look like this, all the way up here. Alright? And now if you draw the pricing line to be very close to here, something like this. So at this price, at this point, the slope here is just negative 1. Okay. Because the price right now is 100. So at this price level today, the slope of the line, of the red line is negative 1. Now finally, let's try when the strike price is 25. So when the strike price is 25, well, PU will be 0, PD will be 0. Because 25 minus 200 is negative, 25 minus 50 will be negative. That means both will be 0. So if you do the calculation, delta will be 0, B will be 0, the put will be 0. Okay, so this put option will always expire out of the money. Because there's only two possible outcomes, either 50 and 200. Right? Okay, but your strike price is 25. You never sell at 25. Because the market price is always 3 and 25. Alright? So if you draw the diagram here, it will something look like this. 25 is right here. Alright? And if you draw the red line, it will be something look like this. So that's why at this point your delta is 0. The slope of the red line is 0 at that point. replicating portfolio approach. Now, in assignment and examination, if I ask you to use the replicating portfolio approach, you have to use the replicating portfolio approach. If you use other approach, you will get 0 for that question. All right? If I do not mention anything, you can use either this approach or the risk-neutral probability approach. Now, one thing about this analysis, you look at it. We never use the P. We never use the probability. Right? Actually, we don't care about the probability because we replicate their cash flow exactly. So this up, I have this one. This down, I have this one. So I replicated the cash flow of the call option or put option perfectly. So I don't care the probabilities go up or down because I have exactly the same cash flow as your call option. Doesn't matter it's up and down. So in this replicating portfolio approach, the probability is irrelevant. All right? Now let's take a 10-minute break, and after the break, we will look at the risk-neutral probability approach. That is, this time we try to use the probability to determine the price of the call option or put option. Right? So please come back at 4:11. Right?
No, I'm doing quick.
Now, if you need
No, wait.
letter size
Wait.
paper for your crib sheet,